Good day, everyone. This is Patrick from EasyFX Code Trading System, and this Saturday, the 7th of January, 2023 now. So Happy New Year to everyone. Welcome back to my channel after a couple of weeks break for the holiday period. I hope everyone had a good holiday period and wishing everyone a healthy, happy, and a productive year ahead. And before I start the weekly analysis, I thought I'll do a quick review of last year, 2022, and across all the major economies. You'll find that basically the narrative is all about the central bank fighting off inflation. So everyone's hiking interest rates, and the Fed starting off with the DXY here. FOMC have raised rates 7 times last year, and now it's at 4.5%. The next meeting is on February 1st, and hoping that they will slow down the rate of increase to perhaps 0.25%. The last increase was 0.5%. After 4 consecutive increases of 0.75% or 75 basis points. So hoping that they will slow down. And so for this is a weekly chart of the DXY. And from the start of the year, started off near the 95 level and ran up all the way to almost hit the 115, so almost a $20 move here. So that's about 2,000 pips. Before this last couple of months or the last quarter of the year, where it slowly pulled back for retracement. And that's because the expectation that the Fed will not be too hawkish and slow down the rate of increase. So that's why the tail off at the end of the year. And we can actually just flip this for the year and see where it's pulled back to now. Is fallen below the 50 pip retracement, and finding support around at the 103 now. So we'll see if it's going to dip further down to test the 62 pip retracement, or in fact down to the next round figure at 101. Where there was a support before, and where it bounced off for a second rally up. So we'll see if that's going to taper off further down to 101. That's another critical support area. Worst case, it may go all the way to test the key round figure at 100. But we'll see what happens in the upcoming weeks, especially as we move closer towards the February 1st meeting. But yeah, that's the picture on the US side. Let's take a look on the Euro. And the ECB has increased rates 4 times last year and moved it up from a negative rate and push it up to 2.5%. But they did start late. They started later than the Fed and Bank of England, and they only started to increase in second half of the year, in starting July of last year, compared to the US and UK, where they started earlier UK started the earliest in February, and Fed started in February as well. So you'll see the impact of the a stronger US dollar due to the hawkish Fed and pushing all the major currencies lower. Almost, and falling from 115 all the way down to almost hitting a 95 round figure before finding some support and climbing back up above parity. So it hasn't gone down to parity for quite a number of years, and has now climbed back up to just above the 106 area. Let's take a look on the monthly time frame, and you see the parity was all the way back from 2001, so 22 years ago. And that's a really drastic fall for the euro. And let's see where it has retraced back to. Yes, it's gone up to almost the 62 pip retracement. Dipped at the beginning of this week, the first week of January, dipped to test the 115 again and the 50 pip. If we take the move all the way from the top and high at the 123, it's just only recovering back up to 38 pip retracement. So there is still room for further bullish move if the US dollar weakens a bit more, and it could try to target the next round figure, very critical round figure at the 110. But we'll see if it's able to get there at all. So the ECB also has a meeting coming up on the 2nd of February. There's a day after the FOMC. Let's take a look at the pound, and the Bank of England has also raised rates 8 times for the year, up to 3.5% now, but still losing out to the US dollar and driving it lower. Plus a couple of missteps from the UK Treasury and the resignation of the Prime Minister then, now with a new Prime Minister, and dipping below 105 here before recovering back up to just almost hitting 125 again. So a strong rebound in the last quarter of the year. And if we flip this, that has hit the 62 pip retracement already. Exactly. And trying to recover back above 50. So we'll see if it's able to recover back, test the 125, and it could mean for most of these pairs, depending how the Fed decides on their interest rates for the year. They did mention in their last minutes that we just came out last week that there will be no cuts in interest rates. So there could be a slowdown, and we'll see at what the pivot level is for the the terminal rate of the interest rate. It could be 5.5, or I don't think it will hit 6. So it could be about 5.5. So another 1% more, and maybe 2 or 3 more rate hikes for the year. And we'll see how they distribute that over the year. But most of the pairs, after recovery, it's difficult to see them recovering all the way back up, as they also have to deal with their own inflation issues, and they will also need to work out their monetary policy as well. Okay, let's take a quick look at the Aussie dollar. And the RBA did raise rates 8 times, but only move it up to 3.1%. Again, this is the weekly chart, and it fell 1,400 pips to a significant low, not quite the low of the pandemic. And managed to recover back up now to the weekly 55 EMA. So if we take a look at the retracement, and it's back up exactly to the 55th retracement. So it's tough to see further bullish move, although it could also try to recover back to the 62th retracement, back to the weekly 200 EMA. And with China opening up its borders, so there could be also, and also cooling off their trade tensions with Australia, so that could help the Aussie dollar as well. Just as a reference, let's see how much move and fall that was for the pound sterling. That was a 3,400 pip drop. And for the euro, it's almost 2,000 pips. So the pound is definitely significant volatility there. All right, so we'll move on to the weekly analysis and continue to see what's ahead for next week. So here's the daily chart for the euro, and at the end of the previous week for the pound, the euro, it after breaking through the this triangle here, it did manage to climb up to test the 107 area, and twice to close around there for the year. But then at the start of the year, it started pulling back, and until yesterday's non-farm payroll report, as well as the ISM services PMI from the US, which dragged the US dollar down and gave a boost to the euro and other major currencies as well. So the non-farm payroll report came out slightly better than expected, but not as high as previous months. So it was 223,000 jobs added. Was an expectation of 200,000. And also the average earnings slowed down as well, so giving some hope that the it will not impact inflation too much. So that could help the sway the Federal Reserve to not increase rate at a higher rate of 0.5 and hopefully lower it down to 0.25% increase. Just a quick look on the 4-hour time frame. That was the initial drop for the week, all the way down, and then managed to cover. This is the 1-hour chart now. So that was Tuesday at the start of the trading week. Monday was still a holiday. That was the drastic fall with the US dollar recovering. Then after consolidation, the Thursday's ADP jobs figure was really higher than expected, and that drove the US dollar higher. But then the non-farm payroll report was a bit lukewarm, so that gave some hope for the other pairs. And after a pause, then the major shock was the ISM services PMI, which came out below 50 for the first time in over a year, and that was a drastic drop. Expectation was above 56 points, but it came just below 49 plus. So that gave added fuel to all the other major pairs, and US dollar fell lower. And you see that it closed strong for the week here, for the euro as well as the other pairs. Going back to the daily time frame. So that was the recovery as it was testing the 105 support, but managed to climb back up above 106. So it's hovering above the 162 fib extension here. Let's see if we take a look at the whole move now. And that was exactly a test of the 21 fib retracement. We could use this to see what the retracement is going to be, if it does hold on or if it does fall off. But now it's trapped between the 107 and just and the 105 area. So if we use this fib as a support, key support well below down here at the 38 fib. And for now, there's interim support at the 105. If before I identify the key resistance up here, and that was from all the way back a couple years, early part of 2020. Let's go back to daily time frame. So that's just above this swing high. We'll see if it's able to climb above 107. But for now, just for the start of the week, and it's trapped between the 105 and the 107 with further support below. Perhaps we can move this up here between the 200 and the 55 here. All right, there no news for the Eurozone, but there is a key news from the US for the CPI data. That's on Thursday. Let's also add one more. During resistance up here. Okay, so we'll see if the CPI data from the US impacts the euro as well, and see if it's going to be lower than expected, then hopefully swing the FOMC to reduce the rate of increase. If that's the case, then the euro and other majors will get a boost, and the US dollar may suffer in the short term. Okay, let's move on to the DXY. All right, so here's the DXY daily chart, and it has been consolidating between the 138 and the 162 pip extension of this reversal move, and tested the 105 just above the 138 here to the daily 200 EMA before falling back down lower, and support from the 103 where the 162 pip extension is. So it's trapped between the 103 and the 105 for now. This is the still intermediate resistance, and above that, that's the key resistance at the swing low. It has fallen lower. And we also take a look at the 4 time frame and perhaps the 1 hour, see what happened on the Friday. But before that, on the Thursday with the ADP private sector jobs report, that was the boost they got with better than expected numbers, and continue to climb into the daily pivot on the Friday before the NFP data came out, which was not as good as expected, and after a pause, then that was the major drop with the shocking figure from the ISM services, which came out below 50. So that drove the US dollar back down. So that's the that was the dynamic, the price action of last night. And this Thursday is the US CPI data. We'll see if that will help the US dollar to recover, or further add the bearish momentum. Let's go back to the daily time frame. And for now, this is still valid. Look at the weekly, and there's a doji there for the week. All right, so this critical support now at the 103. If that support is broken, And the next key one is going to be at the round figure of 101, just above the 100. So 101, there's a cluster here of support. And let's take a look at, yeah, there's this previous resistance, which is now support. And at the 101, there's also another support area. Let's go to the monthly and you will see there was a double top. That's where the trend line comes from. Double top from the start of 2017 and tested in February 2020. So it has it's been oscillating around that trend line. So we'll see whether it's able to stay above the 103. Seems like that's a key level here. And it definitely needs to climb back up above 105. If it's going to recover. But for now, looks like it's just consolidating. And that may persist until the CPI data comes out, and then following a couple of weeks until the FOMC meeting on 1st February. All right. Let's move back to the other major pairs. Let's move on to the pound. Sterling pound, and after hitting a high, recent high, after recovering from a drastic drop at the end of September, managed to recover back up to close to the 125 round figure, all the way from below 105 here. In fact, went down to 103.64. So made a strong recovery and hit the 200 pip extension before pulling back down and back into 120 zone. And yesterday there was the price section with it was actually dipping lower after Thursday's ADP figure, but then recovered with the non-farm payroll report and ISM figures. So it's staved off a drop, a further drop here. And for now, let's see, we'll use this this fib. Let's test this fib here. All from this fall here. Go to the weekly time frame. From this swing high area. Okay. And if we take the whole move, let's see where we are. It's just hanging above the 21 fib area. So it's tough to gauge for now. Let's take this move, and yeah, let's use this instead from the recent swing low all the way up to the recent high. So it dipped to a 38 fib retracement, climbed back up to the 78.6, which is the 21 fib retracement, and blocked along with the fib. There's a 200 daily EMA here. So we could use this. That's the interim support. And the major support at the 50 fib. The resistance is up here now at the swing high, just below 125. And there's the interim resistance at the daily 200. All right, and this week there's UK GDP figure on Friday, but there's exposure to the US CPI data on Thursday, so got to watch out for that. But trapped between these two fib levels now at 118.60 to 121, just above 121, 121.20. Weekly time frame was another spinning top, but with a long wick. So there could be some bullish momentum to push it higher in the early part of next week. Let's see if it's able to break through higher, or it just may end up consolidating as well. All right, let's move on to the Aussie dollar. And the Australian economy, there's the Australian CPI figure on Wednesday. And likewise, they also recovered on the Friday at the expense of the US dollar. And the support area is still safe for now. This critical support is definitely safe. We could add a interim support here. It's coming up against a key resistance. At the 69 level, and there's a 200 fib extension. Let's see if we can fib this whole move. And yes, it's also trapped between these fibs at the 21 and the swing high. But for now, I think we'll leave it back to where it was first until the patterns form further in the next few weeks. Let's take a look on the weekly time frame, and it shows a stronger bullish move, but it's coming up against the weekly 55 EMA here. So 69 is definitely a key resistance. All right. So do check out my other videos on spot gold and dollar yen, and have a safe week and a good trading week. And cheers for now.